Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming up and by and checking out the show with this man, Dimitri Pargamonik. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to help answer your, give you advice, provide you with guidance. There's the disclaimer.
Excellent.
Okay. I'm going to, excuse me, I'm going to share my screen. While I'm doing that, if you guys are joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, data, or analytics. If you want to come on a show and ask your question live, we do provide a link to Zoom on the live chat on YouTube. Once you click on that and get over to Zoom, there's a button, raise your hand. Click on that. Then you could ask your question live, direct. If you prefer to type your question, you can type it into the live chat on the YouTube live chat box. Will's watching it. He'll read it back to me. While we're waiting for questions to come in and more people to join us, we'll start out taking a look at the pre-market report to see if we could get some insights on stocks that are trading in the pre-market hours. Then we'll move on to the questions. If we don't have questions, I'll just navigate to a different part of the website or take questions we had from, emails or previous shows, to discuss that. But will let me know if you do get questions coming in.
All right, perfect.
So, pre-market report. These are stocks trading in the pre-market hours. I'm going to scroll down here, take a look at the three lists we have. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners in the pre-market hours. I see we have 91 stocks that made our percentage gainers list, 41 on our decliners list. So far from this perspective, we're looking like we are lining up for bullish bias at the open. I'm going to come up here and also take a look at this calendar view. And this is showing us from the top high level what's going on in the pre-market hours by date. So you can go back in time. The date today, July 25th. This is what's been happening so far. We have 487 stocks that are trading higher than the previous day's close, 229 stocks trading lower. As far as volume goes, 75.9 million shares are trading higher, 55.5 million shares trading on down volume. And if we convert that volume to dollar value, $2 billion worth of stock trading higher versus 500 million lower. So right now, it does look like we're setting up for bullish buys from that perspective as well. So that's the market breadth. Now let's take a look at a more narrow, focused view of the market. So we could see down here on our percentage gainers list, decliners. We do have small cap stocks in here, ETFs, leverage products, pretty much any security that's listed on a major US exchange. If it's trading in pre-market hours and meets our volume and price thresholds, it can make this list. So let's narrow this down to a smaller group of stocks. And to do that, I'm going to use the filters here above, and let's try this one in ETF. I'm going to click on that. It opens up a drop-down menu with different ETFs in it. Top ones are broad-based ETFs. We also have some sector ETFs. And when you click on it, you'll filter the list below by the stocks that are holdings in that ETF. So SPY, S&P 500, that's the S&P 500 ETF. We click on it, and the list below will get filtered by stocks that are holdings in the SPY. Right here, we see 13 stocks made our percentage gainers list, 15 on the decliners. So that's a little bit different, more of a mixed bag. They're, I would say, close to neutral at the open so far from that perspective of number of stocks that made our percentage gainers list versus decliners. So it's been a couple minutes, Will. If we do have questions, I'll take them now. If we don't, maybe I'll just move on.
Nothing's popped in, D.
Okay. So there's a question, from Rob, who usually he's usually here in the mornings, and he couldn't make it today. And he had a good question, but I was gonna at this point wait maybe till he comes back tomorrow, in case he has a follow-up question, or if I'd misunderstood the question, but it had to do with synthetics. And synthetics are important in trading because it also helps you price out the markets and see if there's some kind of inefficiency or something going on. And a synthetic is saying, well, I could just synthetically recreate the payoff diagram of a different asset, and in theory they should be in line versus as far as pricing goes. So we got that parity, right? Like so a synthetic and the underlying should be should equal out, or there's potentially a inefficiency there that you may be able to exploit. And he mentioned a covered call synthetic, which I didn't actually, I needed to ask a follow-up question. But the way synthetics would work is I'll go to the options chain, for example, and here we have, SPY stock price. Well, I could go out in time. Let's say, we'll go, what's the next month? August 18th. And I could create a synthetic stock using options, right? So synthetic stock would be, I could pick a strike. I could buy a call, sell a put, right? So if I buy a call, sell a put, I calculate that. And you could see that the payout diagram looks like you would be buying a stock, right? So if the stock goes up $1, this makes $1. If the stock goes down $1, this loses $1. So synthetically, what you're doing is recreating the same profile of a stock. That's why I call it synthetic stock. And in theory, right, if we have put call parity, that it should equal out to the same price as a stock minus your cost of carry, right? So you do have to take consider your cost of carry, otherwise there'll be an arbitrage. So because I could create a synthetic long stock, and if I buy it at a discount, I could short the stock and wait till expiration and make the difference, or vice versa. I could buy the stock, create a synthetic short stock, and if I'm selling it above parity, then I wait till expiration, and then I make the difference. So it's basically you offset the risk, right? So look, here's a synthetic short. I mean, this is a synthetic long stock, right? So you could see, well, how would I hedge this, right? How would I hedge this? Well, if I'm synthetic long, 100 shares, well, I could sell 100 shares. Let's sell 100 shares, right? And I'm going to recalculate that. So you see here, so what's going on here? Well, no matter where it moves, no matter where the stock moves, right? I'm always getting the same payout. The stock moves to 480, I'm losing 175 bucks, let's say. If the stock moves to 430, I'm still losing $175 because what's happening is these two positions are hedged off, right? I have a synthetic long and I shorted the spot price. So wherever this, so that directionally, it doesn't matter where it moves, those deltas are offsetting each other. And because I bought and sold an option on the same strike, I don't really have decay risk or theta risk because there's, I bought and sold on the same strike, right? So what's going on here? Why am I losing 175 bucks if I do this? And of course, if I do the reverse, I'll be gaining 175 bucks. So where's this coming from, right? Why isn't this right at parity? Because I could do the reverse, right? Let's say I buy 100, I'll sell the call. Here, let's do without this first. Let's do 0. So now I'm selling the call and buying the put on the same strike. See, selling the 454 call, and then I'm buying the 454 put. So now what do I have? A synthetic short, right? So as the stock goes down, right, this becomes more profitable. If the stock goes up, then this position is losing money, just like a short stock. So you see that 1 for 1, right? That's your slope. 1 for 1, you got exactly a 1 delta, right? And if I hedge this, so what do I do to hedge this? If I have a synthetic short, I could go in here, right, and hedge my delta. So I buy 100 shares. Calculate that. So what does it look like? No matter where the stock goes, doesn't matter where the stock goes, right? Down to 430, up to 480, does not matter, could stay the same price. It always shows profit of 172, right? So where's that coming from, right? So where's that extra, credit coming from, right? Or debit if you did the other side. Well, in finance, right? In finance, when you're moving money around, there's a cost of carry, right? There's always some kind of cost when you're moving money around. So if I do this strategy, right, I create a synthetic short, but I do have to buy 100 shares, right? I have to buy 100 shares of SPY for 454.04. Well, if I'm buying 100 shares of SPY, which is, what is that, like 45 grand or something? Well, so if I'm so if I'm buying 100 shares of SPY, that means that the cash, either I have cash sitting there that I had to move from an interest-bearing account to buy it, right? So assuming if you're efficient, right? If you're efficient, that means if you have cash, it should be earning you interest, right? If the risk-free rate is paying 5%, you should be earning around 5%. That's in theory, right? If you're efficient, it shouldn't be sitting there earning 0. Because remember, in the financial world, we're always assuming you're being efficient. So if you're moving that money from an interest-bearing account to buy the stock, that means that you are losing the interest that you would have earned, right? So now you move your money from interest to buy the stock, and now you're carrying this position. So that's why the options, they're efficient and they know this, and this is why the synthetic, right? If you're moving it, the synthetic is the difference. It's paying that interest, right? That would be the interest you forgo to carry this position, that's where the options are pricing in the carry. So in reality, there shouldn't be, the difference between this and you just sitting in cash, right? Because if this is paying more than the cash, if this is paying like say 10%, right? Let's say this is a 10% return and you're getting a 5% return. Well, then you're better off moving out of the interest bearing account and doing this strategy, because you could carry it and earn a higher yield. Okay, so this is where it's come from. So that's what we're talking about when we're talking about synthetics versus cash. There should be a relationship that makes sense, or it could create perhaps an arbitrage opportunity or an inefficiency that you can exploit. So one of the checks we do is, how are the synthetic markets compared to the cash markets? Okay, so what about the flip side? Well, why are we paying, right? Why are we doing it the other way? Well, let's go back. So if this makes sense, why would we pay, right? So here we go. We're buying one call, selling one call, right? No stop. So now we have this synthetic long, but we're paying $1.79 for this synthetic long, right? So stock is 454.04. We're doing the 454 strike, but why are we paying $1.79 over the 454 strike, right? That mean, because if we buy the stock, we could buy it at 454, but instead we're buying it for 454 plus $1.79, 455.79. So why would we do that? Well, now let's take a look at the reverse. What if we hedge this, right? So we're paying 179. But what if we hedge this? What if we said, okay, I don't want to take on any of this delta risk, right? This is a synthetic long. I don't want to take on, and I'm going to hedge this so this way I don't have any directional risk. Well, to do that, I need to sell 100 shares, right? So I sold 100 shares. I'll go, oh, well, wait a minute. If I wait till expiration, I'm losing 175 bucks. What's going on? Why would I do something like that? Why would I want to lose 175 bucks, by doing this synthetic? That may not make sense. But what's going on here? Well, here, yes, we did pay 175, but look what we did here. We sold short 100 shares of SPY for $454, 45 grand. Well, when you sell something short, right, you borrowed stock from somebody, you sold 100 shares at 454. So what happens? Well, if you sold it, that means that you received money, right? Somebody bought it from you. That means somebody gave you money for your stock. So now you have this money sitting in your account, right? So since you have this money sitting in your account, and if you're efficient, it should be earning you the interest on that account, right? You took that money in, right? Then you should be earning interest. You're holding it for a month or whatever. You should be, buying the 1 month treasury or whatever it is, but it should be earning you interest. And what you're losing on this strategy should be made up in the interest that you earn during that holding period, right? Because this will expire in 19 trading days, whatever, let's say in a month. So this is, August 18th. Well, that means that you should earn that, at least that amount of interest to offset it. Now, if you could earn more, then the strategy is great. So let's say you earn $2 in interest, right? You found a place where, hey, this treasury is paying an amazing interest rate, right? The US Treasury is paying an amazing interest rate, or your broker is giving you an amazing interest rate, and you could take that money and earn a higher interest rate than the market's implying. Well, then you should be doing this, because then you're paying $1, you're going to lose $1.75, but you're going to earn $2 in interest. So that would make sense to do, right? Because now what you're doing is you're like a bank, right? You're borrowing at one rate, you're lending at a higher rate, and you're making the difference. So that would be something why the synthetic markets are very important as a way to look at the spot or cash markets to see, are there inefficiencies there that you could potentially exploit, and you're putting all the pieces together, right? So when Rob asked me about the synthetic markets, it wasn't very clear, because he said it in a way I need a follow-up question. He mentioned, how did he say it? Like a covered call, synthetic covered call? I'm not sure exactly how. I don't remember exactly, but it's something like a synthetic covered call. The idea is, when there's a synthetic, right? When you're a synthetic, is you're basically recreating something that that looks like the spot market. And if they offset each other's risks, then you got to see, well, is there a mispricing perhaps that I could take advantage of, right? And then you're always looking at that. So that's really quickly, I wanted to go over the synthetics. I don't know if you have any follow-up questions, but I'll end it here if there are no more questions.
Yeah, there were no questions popping up about the synthetics. We did have a question concerning, I mean, it was probably one of the reasons you were looking at SPY. How does the rebalancing work? I think Gene asked, rebalancing of the SPY. Could you explain why and how that affects the SPY? I mean, it's, you know what, we only got 7 minutes left. Maybe we could do that tomorrow.
Yeah, and right. And I don't know if I could explain there could be a lot of questions with how it works. And, if the question is, look, how do they determine which stocks go in, which stocks come out, by how much, that's actually handled by the the provider, S&P 500 provider, and they don't give all the details of this, but you'd have to read it, because you'd have to read the prospectus. I can't say I'm an expert in the rebalancing of ETFs or indexes, because they do use different methodologies and reasoning. Sometimes they don't give you all the details. So maybe you're looking for some specific question regarding it. So I would point you to their prospectus, or even the index provider, because even the SPY, right? The SPY is an ETF that's trying to it's trying to replicate the S&P 500 index, and the S&P 500 index is managed by the provider that has a methodology, right? So we know it's like a cap weighted and all this, but they do, and
really at the end of the day, the biggest effect will probably be on the stocks either leaving or entering, right?
Right.
The index,
right. Yeah. So there might be, exactly. So there could be an impact when they announce which stocks are getting taken out, which stocks are going to get put in. I mean, if you're trying to forecast which ones are going to come out or come in, you could try to look at their methodology. I mean, I'm not sure where what the answer, it's a general question. How does it work? but
Yeah, what you're going
you
through right now. I
know,
know, I think the QQQ just did an interesting one because the biggest 6 stocks made up, based on how the index is supposed to be made up, they
right.
made too much of the size of the index, right? So they had to pull the amount of those stocks out somehow.
Right. So let's just take a
QQQ
look
just went
here.
through that.
Here's QQQ, right? I'm just going to look at the top 10. Wait, let me see here. Let's look at this. So here are the top 10 holdings in QQQ right now, right? So it has 100. Hold on, let me just make sure. I think it has like 100 holdings, right? Sometimes they put 101. There could be like a cash component there, but let's just take a look at the ETF profile. So the top 10 holdings, Apple, Microsoft, Amazon, NVIDIA, they're right here. Google, really, they have 2 classes. So really, you could say, these are the top 9, right? Top 9 make up 48.4% of the index. And this is the methodology, they're using the cap weighted, and you could read about it. Whatever they reveal about it, you could read about it on the NASDAQ 100. But right now, it's making up 49% of the holdings, and they might change that. I don't know if they want to. I don't know if they want to rebalance it in a way that this doesn't happen. But like you could
Well,
see,
I think they did. They're going to. It's announced in QQQ, and it's based on that they make up. Literally, was in the makeup of the index. That they make up too much of the index. It's the second time I think in their history they've had to do this.
okay,
So,
right,
yeah.
So I don't know exactly. Yeah, there are lots of different index providers. They have their own method. They do their rebalancing, and I can't say I'm like an expert in like those methodologies.
All right. Great stuff, dude. As always. Thanks for giving that to the Chameleons. It was a great show today. Thanks.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
All right. Trade in peace, Chameleons. We'll see you tomorrow. Thanks, D.
Right.